There is a lot of stocks in the stock market to choose from, and it gets quite hard to choose one and pick one and choose the specific one that is gonna get you a passive income from your investment. That's why I'm here to show you some tips that will help you get the most out of your investments. I'm gonna show y'all the specific tips that you should follow to be rich and to get a passive income out of your investment in the stock market, and how to choose from all these stocks. The tip number one is never invest in a business that you don't understand. Now guess who said this quote? This quote comes from Warren Buffett himself, the idol of all investors out there. One of the most common ways investors get burned by a stock pick is when they don't understand how the company works, or blindly invest in it based on a hype and fear of missing out. A great example is the recent meme stock craze. Investors can avoid this by picking companies with solid, easy to understand business models that produce everyday services and products they personally experience. Think of companies like Coca-Cola, McDonald's, or all these companies. By the way, I'm not picking stocks for you. I'm not a financial advisor. Don't buy stocks through me. I'm not a financial advisor. I'm just a stock guy. I do stocks. Okay? Are we clear here? I hope we are. If you find yourself struggling to understand or explain what the strategy of your company is, what its core value proposition is, and how exactly it makes money, it might not be a good pick for you. So choose wisely. Now, the second tip from me to y'all is understand financial ratios. Now, some people are going to think a ratio plus y be better. No, that's not what it means. Financial ratios are the ratios that are going to help investors calculate and know how the company that they are going to invest in is managed, know its historical growth, and know if the company is profitable or no. And you can know by financial ratios if the financial situation of the company is stable or not. Financial ratios are really important. You should compare financial ratios between different years and also peers of a similar market capitalization in the same stock market sector or industry. The third tip from me to y'all is watch out for value traps. Now, I like to call it watch out from content creators that do ads to stocks. Value stocks are those that appear to be cheaply priced. Now, new investors always get scammed by these type of stocks. The fourth tip is avoid chasing high yields. New dividend investors often screen for stocks with high dividend yields, but this approach can lead to holding unprofitable companies because dividend yields are calculated by the annual dividend per share divided by the price per share, the stock price per share though. A good way to screen for a yield trap by checking the company's payout ratio, calculated as company's annual dividend payout rate divided by its earnings, not by the price per share. No, do your calculations right. If it's over 100%, the company is not good for you. The company is not profitable. Well, it's profitable, but it's not profitable enough to pay its dividend using retained earnings and maybe taking on debt. elsewhere. Number 5, the tip number 5, check insider activities. Now, insiders are always more likely to know what the best valuation for their company truly is. In general, investors should pick stocks where the management team has a strong stake in its future performance. A good way to screen for this is by checking for insiders. That will tell you or give you a good view of buys, sells, and options exercises. Now, the last one is understand market risks. No matter how solid a stock pick is, it's subject to market risk. This is the risk of your investment losing value when the board market takes a downturn. Even if the company situation have not changed in the slightest, market risk can be measured by beta, which calculates how sensitive a stock is to market movements in the direction it tends to go. There is also one tip that I would like to add, but it's not really that important, which is assess the economic moat. By the way, I just like to add this one. It's not that important. You can go ahead and ignore it. Now I will repeat them all for y'all. How to pick stocks. 7 things all beginner investors should know. First one, never invest in a business you don't understand. It's completely understandable. It's clear. The second tip, understand financial ratios. Now we talk about this one, not ratio plus YB better, not that one. The third one is watch out for value traps. The fourth one is avoid chasing high yields. The fifth one, check insider activities. The tip number 6, understand market risks. And the other one that I added, assess the economic moat. Now this one is not really that important, but I hope the video was helpful. I hope you are going to get in the stock market because of this, because of me. I tell you how to do it, I show you how to do it. Maybe I'll make other videos. If you need anything about the stock market or penny stocks or the crypto or anything, just ask me in the comments. I do this stuff for a living. I'm professional at this stuff, but I'm not a financial advisor. Your money is in a great risk. If you take my words to the heart, you should analyze the stock market yourself before following me. No, I mean, you can follow me, you can watch the whole video and then go and do your studies and watch out the stocks and analyze them, and then you can choose to buy or leave it alone.